I published a book in 2017 where I said that a house is not an investment. 8 years later, I still believe it. Was I right? Ted's here to discuss it. Let's begin.
This is Debt Free in 30. Here's your host, Doug Hoyes.
So Ted, you remember my book, Straight Talk on Your Money, which of course is always behind us here. In chapter 13, I said that a house is not an investment. And 6 years after that book was published, house prices kept going up with a big spike up, of course, during the 2020 to 2022 period. Since then, prices have kind of peaked and in some markets have eased off. Here we are in 2025 and house prices are not at record highs, although people watch this podcast many years in the future.
Right.
Like it's bizarre. We get like, gee, we had 50 views last month on that podcast from 4 years ago. Like it happened. So whenever you're watching this, take everything I'm saying, I guess, with a grain of salt. So now, of course, most people listening are going, okay, Doug, you're an idiot. Sure, maybe house prices have eased off, but they don't go up in a straight line. Like
over time, that's right.
Yeah, over time, the long-term real estate goes up. It's a great investment. So, okay, that's the other side of the story. So I am of the view that a house is not an investment, and it's definitely not an investment if you can't afford it. So let's dig into this, and you can tell me where I'm wrong, because everybody watching this is going...
Well, so you could drop the whole house thing, though, right? An investment is not an investment if you can't afford it. Why are we just... We're talking about houses because houses are so common and because so many people think they are investments.
Well, yes, exactly. So many people think they are investments. Like if you buy a guaranteed investment certificate at the bank... Right. Okay, you got a pretty good... You can pretty much project what's going to happen with that.
One would hope.
You can factor in inflation, I guess, and so on. So okay, let's break this down then. Let's start with what is an investment? How would you define the word investment?
So you're making a contribution of money, purchasing an asset with the intent that it's either going to increase in value or give you some sort of rate of return.
There you go. And it's pretty much simple. You're either getting like an interest payment every month,
right? Or
when I sell it, it will be worth more. Now, if you're renting out a house, then I guess you're getting a payment every month.
Assuming your cash flow is positive.
Which it probably isn't. But
these days it won't be,
That's
right?
another, well, it depends, I guess, if you've got a mortgage or not.
Right.
If you don't have a mortgage, sure, it'll be cash flow positive by quite a bit.
Yep.
Most people, it's like, okay, I'm buying this house, I'm renting it out, and 10 years from now, I'm going to sell it and make tons of money. So that's why they think it's an investment.
Right.
Okay, so what I did was I went on to the AI.
Okay.
Because that's how I do my show prep now. Mm-hmm. None of this is real. It's all just AI. And I said, okay, Mr. AI, what? Maybe it's a Ms. I don't know.
Anytime you say that, I think of Max Headroom. Sorry.
There you go. And again,
the first AI.
People are watching Max Headroom?
Who the hell is he talking about now?
What is this, 1980? I don't know what year that was, but it was many years ago.
Yep.
So when evaluating an investment, there are, 4 things you got to look at. So, risk versus return. Okay, that kind of makes sense.
Okay.
Don't think.
And that's straightforward. The higher the risk, the greater the return has to be to justify making the investment.
Or else why am I doing it?
Right.
Exactly. So, I mean, you, of course, are a huge crypto investor, as everybody on this show knows. You're expecting a huge return, but you understand there's big risk involved.
Right.
Time horizon would be the next thing.
Sure.
So I get a 1-year GIC from the bank. I know exactly what my time horizon is.
Yep.
With the house, it's like, well, okay, when will I be selling it and cashing in? So there's a time horizon thing.
Less certainty there.
Now, there's 2 other points that I want to talk a little bit more about. Liquidity and diversification.
Okay.
So liquidity means, well, the word...
How quickly can you sell?
Exactly. How quickly can I make it liquid? How quickly can I turn it into cash? That's the question. So if you buy, well, back to your crypto example. I guess it was my example, but you can sell your crypto, boom, right away.
Sure.
A better example would be a stock. You go onto your stockbroker platform, you can sell a stock, and the cash is there.
Publicly traded versus privately traded.
Yeah, if it's a private company, totally different story. So what is the liquidity of a house? How long does it take to turn a house into cash?
I guess it depends on how strong the market is.
It's not a day, though.
It's certainly not a day. Might be 30 days if you're really lucky or you're willing to take a bath.
But typically you're looking at months. Because I list my house for sale today, maybe it sells in the next month, but the closing date might be 2 or 3 months after that.
30, 60, 90 days.
And you're right. In the middle of January, when it's winter outside, there's not as many houses closing as in June.
Well, particularly for families, because nobody wants to move their kids in the middle of the winter. They'll wait till September.
Till the school year starts.
Yep.
So liquidity, okay, that's an issue. And then diversification. So would you agree that the average Canadian who owns a house has a significant portion of their wealth in that house?
Certainly.
Because a house costs $1 million.
Yep. And most of them don't have sufficient funds that they can invest in other things.
Because they've invested in the house.
Right.
So the two big issues I have with the whole house as an investment thing, ignoring the whole risk and return thing,
right,
are liquidity. You can't just sell it instantly, and diversification. If your entire wealth is in your house and the market crashes, then you got a problem. So that's
okay.
So let's keep those thoughts in our mind. Now, why then is a house not an investment? So, and I got like 8 different points here I want to talk about, and you're gonna comment on each of them.
Okay.
But my basic premise and what I said in the book is that a house is a consumer good.
Yeah, it's someplace to live. That's your position. You got to live someplace. Might as well be a house.
Exactly. And I'm holding a pen in my hand. A pen is a consumer good.
Sure.
I use it up. And then, well, it's no good anymore. I throw it away.
Could be advertising if we had a sponsor.
Well, in fact, we'll have to get it does say Hoyes Michaelis on it. This podcast brought to you by Hoyes Michaelis because we could not find any other sponsors. Nobody considers this to be an investment.
Not that particular pen.
No. Now, it could be that you and I become very famous from this podcast that we've been doing for 10 years, and the Hoyes Michaelis pens have a premium and people want to buy them.
Well, but there are certainly pens out there that could qualify as investments.
Because that's the pen they signed the Declaration of Independence.
Yeah, they're collectibles for some reason. It makes them unique.
Or something, right. But for the most part, you use it up, you throw it out. And I'm of the view that a house is exactly the same.
You use it up and throw it out?
Yes, that's exactly what I believe. Now, people are going, that's stupid. Well, no, it isn't. So you have a roof on your house.
We do.
Or if you're an American, it's a roof. Is that how
I don't think so.
Anyway. Okay. So does your roof last forever? No. It eventually wears out.
Typical single roof, 25 years.
There you go. And you've got, furniture, carpeting, plumbing, everything. If you have 100-year-old house,
right,
how much of it is still original? Very little.
Question. The more of it's original, the more it's probably worth.
Yes. The brickwork is probably original.
The stone foundation.
But the appliances, nope, they've all been done. The electrical system, the plumbing system.
So are you expanding the house's investment to house in all of its contexts and services that you require?
I guess so. But what is the definition of it? It's just the walls? Well, no, it's got to have electricity. It's got to have plumbing. It's got to have everything.
Right.
So if you look at, and you've been a homeowner now for many years.
Yep.
You know that every year you are spending a bunch of money on repairs and maintenance.
Something's going to break.
Something breaks.
Things wear out.
So that's the other reason you can't just think of it as an investment. It is you have to think of it as a consumer good. That's my basic principle.
All right. I'm trying to think of this now if we're applying that definition to other types of investments. So if I own a stock, I don't really have to do any maintenance to it every year.
Right.
I just have to check and make sure that it's still worth having my money in it.
I'll give you a better example. Cars. Are cars an investment?
They're certainly a popular investment right now.
But
if you don't maintain them, they go down in value very quickly.
So I guess if I bought a 1960 Corvette, was there such a thing? Did they make?
Yeah, they started making Corvettes in 55.
55, and so
53.
I assume that has some value.
It does, depending on the condition.
And if I've stored it in a hermetically sealed environment up on blocks, I don't know how you store a car, but it is most definitely worth more than what it was worth when I bought it.
Cars are interesting, but anyway, probably unless you want to do a whole show on cars as investments.
Leave a thing in the comments, people, and we'll do a whole show on cars.
Because cars peak and then they drop off depending on the age of the customers.
Right, because that car that was cool in 1960 would be cool to somebody who was alive in 1960.
Alive and driving.
And driving. And that person is pretty close to dead now.
Right. So those cars are all coming down in value unless they're something exceptional about them.
And so the peak year now is what, 1980?
There aren't a lot of great cars from the 80s.
So,
but anyway, we're talking about houses today as an investment.
The point being,
let me distract you.
With a car, if you're driving it, it certainly
maintenance
requires
and
maintenance. So it's even if it's a collector's car, if you're driving it every day, it goes down in value.
Yep.
It's the same thing with a house. Now, let me start throwing these things at you and you give me your thoughts on it. So the title of the show is A House is Not an Investment If You Can't Afford It.
Right.
I believe it's not an investment anyways, but particularly if you can't afford it. And can't afford it means, okay, well, the financial strain that it causes you. If it costs $2,000 a month to rent, and people say, oh, well, my mortgage is $2,000. So there you go. You see, it's good.
Right. But there are more things you have to pay for.
Yeah, like a whole bunch of more things.
Yeah, all your utilities, property taxes, and your maintenance and repairs.
And which could easily be another.
You could double it.
Yeah.
I mean, when we started this business way back in 1999, our prediction was at that time that owning a home cost you 25 to 30% more every month than renting. I think that number's low now because of the inflation and simply the cost of borrowing these days. But
right. And so we're talking about opportunity cost here, right?
Okay.
So if it costs, and again, we're using simple numbers here so we can do the math in our head. It costs $2,000 a month to rent, and I don't have to worry about repairs and maintenance or property tax. It's all included. Right. I still have to pay utilities and so on, but I do that in either case. Or I can buy a house and my mortgage, repairs and maintenance, property taxes, condo fees, whatever, are $3,000 a month. So there's $1,000 differential. And let's assume we're talking about the exact same property.
Yep.
Okay. So my cash flow is depleted by an extra $1,000 a month.
Right. So that property better be going up by at least $1,000 a month in value.
Or I'm somehow getting $1,000 more of marginal utility out of it.
Somehow.
And maybe I am because I can paint the walls whatever color I want. I can have a pet. I'm struggling here to think of any other reason that justifies that. So okay, that's I think the first key issue that people have to understand is it is almost for sure costing you more than renting
to stay in a house
if it's the exact same thing. So if I can afford the $3,000 and I decide to rent, that means I got an extra $1,000
to invest. Or do something with it.
Right. And let's assume I invest it and let's assume I'm getting, 3 or 4% on it. Well, then over time, that's going up quite a bit. So for the house to be a proper investment, not only does it have to increase by $1,000 a month, more than what I'm paying in rent, but also
whatever your opportunity cost is. Sure.
So I think from a math point of view, it doesn't make sense. Well, I shouldn't say that.
Yeah, historically, it has, right?
During certain periods, it obviously has. When house prices in 2020 were going up by 30% a year or whatever it was, there was no other investment. Well, I guess a bunch of stuff. Stocks were going up, crypto was going up, whatever. But I get it. In that limited period of time, pretty good investment.
Right.
Over the longer period, not so much. Now, we talked about liquidity. So that's the second thing you got to be really aware of. And then we just talked about opportunity cost.
Right.
Now, the counter argument to all this is, okay, Ted, we get it, but you're not going to be taking that extra $1,000 and investing it.
Right.
You're going to be spending it.
Sure. I'll get a nicer car. I'll take a vacation. I'll eat better. Who knows what I'll do with it?
So do you agree
My wife will spend it.
That's right. Something will happen to it. Do you agree that a house is a very good forced savings plan then?
Sure. I mean, it's an easier to follow savings plan because you don't have a choice except to make those mortgage payments, and you can't activate or access that increased equity very easily. And so you can't take the money out that you're starting to accumulate.
Right. So the disadvantage of liquidity becomes an advantage.
Right.
It's something that's locked in. So if you are advising someone who's never been great at savings, and they're saying, I'm thinking about, should I buy a house? And you explain to them, well, but it costs $2,000 to rent, $3,000 to own. You could take that extra $1,000 and invest it. And they go, I know I won't.
Right.
So then I guess, even though based on the $2,000 versus $3,000, it doesn't make sense, but you are forcing them to save.
Yeah, but there are ways we could set up some sort of savings plan for that person where they'd have a great deal of difficulty getting at that $1,000. So we could make it as unliquid, as a house.
So you're talking about a forced savings plan in some case.
Something, that's right.
So that you automatically, it comes right off your
It's
paycheck.
coming off the source and it's going into some sort of vehicle that's very difficult to get the money out of.
A locked-in GIC or something.
Right.
But it's kind of hard to have a locked-in GIC that you put $1,000 a month into that isn't like are you going to buy a separate GIC every year with a 5-year term? Like maybe it's possible. I don't know.
But anyway.
But I guess the point is, okay, the argument in favor of it being an investment is I got no choice.
Right.
I can't take it out.
The words you were using were forced savings.
Forced savings. Okay, now number 4 on my list, negative equity.
Mm-hmm.
Okay. If the house, this is what AI told me. Okay. So I'm going to read it here and pretend it's my own words. If the housing market declines, you could end up owing more on your mortgage than the house is worth.
That's not happening to anybody right now, is it?
Not yet. Well,
it is.
If you bought right at the peak
Mm-hmm.
in, 2020, 2021, and in effect even overpaid a little bit.
Right.
Well, if you put 5% down and the prices are 10% lower.
You're negative equity.
And what are the implications of that? Like so what?
Well, so now you've got, you owe more money than the underlying asset is worth. So even if you decided you were going to sell the asset to try and clear yourself out, you can't. There's going to be some balance owing at the end of the day. So your argument that the house isn't an investment, well, if it was an investment, the goal is when you sell it that you got money in your pocket. In this particular example, no, you owe money.
So if I bought a pre-construction condo, and this I think will be the story of 2025.
Right.
Because you and I have both had numerous calls from people who said, yeah, I bought a pre-construction condo. I agreed to pay $1 million. This was, of course, 3 or 4 years ago because it takes a long time to build that tower.
And they kept delaying them.
And they kept, And now it's the builder saying, okay, it's time for closing. You got to come up with $1 million. I put down $50,000 or $100,000 or whatever it was. I go to the bank and I say, hey, I need a mortgage to pay the rest. And the bank goes, well, we've done an appraisal and the place is worth $700,000.
Right.
You got a problem. Because if the place is worth $700,000 and the bank's going to loan you at most 95% of that,
right,
then you're $300,000 short or something.
You got to come up with some cash.
That's pretty much negative equity, right?
Right. That's a great example.
So, and a horrible example. Now, people are going, okay, but that's silly. That's not that many people. How can you possibly have negative equity if you actually own the house? Well, I already gave one example. You bought it at the peak.
And so negative equity only applies if you're going to sell the house or if you need to refinance it and they basically call your loan because it's worth less than that.
Okay, so let's talk about that because that is exactly the key point. So I buy the house at the peak. I've got a mortgage that renews again in 5 years.
Right. So as long as the mortgage company lets you keep paying and when you renew in 5 years, it's worth more. Your negative equity's disappeared, you're probably okay. So,
and over a 5-year time horizon, you've got more of a chance that it's, stays the same or goes up in value than over a 2-year time
Historically,
horizon.
It'll go up 2 or 3% per year unless there's a correction. So if it's gone down 10% now, 5 years, it's gone up 15, you'll be a little bit ahead.
Yeah, and if it crashes 2 weeks after I buy it, it doesn't matter. My mortgage is locked in for 5 years. The bank doesn't care so long as I'm making my payments.
Correct.
When it comes up for renewal, the bank is probably going to go, you know what? You made your payments for 5 years. We've already loaned you the money.
Unless there's some reason for the bank to be concerned. It have to be, and just negative equity isn't going to be a big enough reason.
Right. They've already loaned you the money.
Right.
So it would be kind of crazy for the bank 5 years out to say, well, you know what? There's now less equity in this house. We're canceling your mortgage.
Right.
Okay, well, then that means you're taking over the house and you're losing money. So it's much easier for the bank to kick it down the road.
Right. But
and you're right, negative equity has not been a thing for the last 20 years.
Right. It is right now.
But it is right now. So I think that's a considerable thing to think about. Okay, now here's the next one. And this is not actually let me skip over to maintenance and upkeep because we already kind of hit on that.
Right.
And you said sort of 20 to 30% is kind of the rule of thumb.
Yep.
And it might even be higher than that. Sure. I guess it depends if you have a major repair.
Yeah. So this is something people don't often think about, but if you're involved in a condominium corporation, they have to plan out when they're going to do major work on the condominium. So we're going to do the roof, we're going to do the walkways, the pathways, we're going to do the plumbing systems, whatever, right? And they've got a reserved schedule on when those things have to be paid for. But when you have your own house, you don't have a schedule like that. All you know is that the shingles are good for 25 years and the previous owner did them 5 years ago, so I should have 20 years. If the weather's particularly crappy, maybe that's only 10 or 15, or maybe it holds out till 30. You don't really know. One of your appliances is going to blow up. Well, the older stuff is probably better than the newer stuff because anything you buy now is good for 3 or 5 years, right?
Yep. Yeah, if you got a 30-year-old dryer, it'll probably last for another 10 years. If you just bought a new one, it'll probably last for 4.
Till the warranty's done.
Right, exactly. And when the washer goes, the dryer goes because they both talk to each other.
Right.
Now, your example of the condo is an interesting one because you're right. The condo corp is supposed to have a fund.
They plan out basically the reserves for careers and for maintenance.
But of course, a lot of the newer buildings that are being built are not as high quality as perhaps buildings in the past were.
And they're not fully funded.
And they're not fully funded because they haven't been around that long.
Right.
So we've certainly heard stories of that condo corp where, oh, you know what, the elevators, it turns out, we had a design flaw. We put the plumbing in the elevator shafts because that would made it easier to get the thing to the next level. And of course, the pipe bursts, and now the elevator, and we got big repairs and so on and so forth. And this is going to be $100,000 or $1 million or whatever. So it is very possible in a condo corp to get a special assessment.
Sure is.
Where you got to come up with a massive amount of money.
I mean, more likely the township or city is going to change a bylaw that they've got to comply with that nobody could have ever planned for anyway.
And now we got to come up with that kind of money. So these are a bunch of problems that could hit you. Now, here's one that is not a financial one. Emotional and health costs. Mm-hmm. So living in a home you can't afford, obviously, is going to add stress, which of course will affect your health and decision-making and so on. And that's not very conducive to rational things. The flip side, though, is, but it's my own home.
Yeah, I mean, the argument's always been made that the homeowners make better citizens than renters because they're committed, they're invested in the community that they're living in.
And whether that's true or not, I don't know.
Who knows, right?
Maybe it is.
Maybe in the 1950s when everybody was, happy days.
Ward and June Cleaver.
Mm-hmm.
If you buy your house, flip it, and move to another one and another one, and another, okay, well, then you're really a fancy renter then,
right?
I would say. So I can make the argument that home ownership, exactly like you say, kind of gives me roots and stability, and this is where I'm raising my kids, and I know all the neighbors. But I can also make the opposite argument that I'm house rich and cash poor.
Right. And that happens all the time.
So I'm so worried about if the washing machine breaks, I literally can't fix it. I don't have the money.
Well, remember, the advice used to be buy as much house as you can possibly afford. So stretch to get as much, because over time your income should go up and things will get better.
Well, and certainly during a low interest rate environment, back 2, 3, 4 years ago when you could get a 1.39% 5-year mortgage.
Money was free.
Like, why wouldn't you? Why wouldn't you load up as much as you possibly could?
Because when interest rates go back to 7%.
Which is the next item on our list here, which is interest rates. So, without giving specific numbers, explain what the difference is between a 2% mortgage rate and a 5% mortgage rate.
Well, in simple numbers, let's say you've got a 2% mortgage and your mortgage payment every month is $2,500. If it suddenly jumps to 5 or 6%, your mortgage payment's going to jump to $3,500 or $4,000.
Yeah, and an even simpler example would be a HELOC that's interest only.
Right.
So if your HELOC went from 2% to 6%, and I'm just making up numbers here.
Yep.
Okay.
On $100,000, it's $2,000 a year or $6,000, right?
Right.
And so if you've got $500,000, it's $10,000 versus $30,000.
And so on a monthly basis, your payment went way up.
Right.
Obviously, it tripled in that example.
Mm-hmm.
So interest rates are something more and more people are becoming aware of. And so, of course, in 2025, we've got people who got their mortgage locked in 5 years ago when rates were much lower. They're now renewing, or people, it was 2, 3, 4, whatever it was.
Well, that's exactly what's been happening for the last 6 months. Anybody that's been forced to renew is now renewing at a significantly higher rate. And the decision they had to make was, well, do they stay on a variable rate or do they lock in? And anybody locked in the last 6 months probably made a mistake because the rates have been coming down.
Right. And will they continue to come down? I don't know.
And historically, you should be paying 4% for your mortgage. That's just the way it was for a very, very long time.
Yeah. And I guess obviously the inflation rate has a big component of that. And,
obviously.
Again, the point is, with most investments, that's not an issue.
Right.
You're getting paid. Now, I guess if you bought all your stocks on margin or took out a bank loan to buy stocks.
And there are people that do that.
Many of our clients, yes.
Right.
Not many, but it's not unheard of. That's for sure. Then it can really, really come back to bite you. So, okay, final item on my list here is forced holding. If you can't afford to move or upgrade due to financial constraints, you might miss out on better investment opportunities elsewhere because you're locked into your current property. Okay, that's obviously written by AI. Let me put this in real English. You get a job offer 4 towns over.
Mm-hmm. Can I sell my house and go to the new one?
No, because
there's no liquidity here.
There's no liquidity here. I've got a mortgage that still has 4 years to run. And so maybe I can port my mortgage to the new place.
Maybe.
But it's going to cost me money to move to the new place. Mm-hmm. And maybe in that town or that province, prices are higher, lower, whatever.
Right.
So I do mention in, Straight Talk on Your Money, still available as a Kindle version on Amazon, that a house can be like an anchor.
Right.
You're completely locked in and can't move. So
anchors have strength. They're good things and bad things, like everything else.
If it keeps you from getting blown away, then it's a good thing.
Right.
Now, some people are watching this and going, okay, yeah.
You guys are nuts.
You're nuts. And you're missing the point here, because the reason a house is an investment is because you can rent it out. That's why it's an investment. Mm. And the theory is the tenant is paying your mortgage, paying all those expenses.
Right.
Now, we know today if you buy a house, a condo, whatever, 5% down, the rent is not going to cover your mortgage, your property taxes, your condo fees, and so on.
It's not going to be cash positive.
And it hasn't been for quite some time. This is not a 2025 thing. This has been going on. The amount goes up and down, but it's profoundly negative right now.
Right.
So that's, what's your advice on that? If you want to be a landlord, then you got to have a big down payment?
If you're going to be a landlord, then you've got to think it out very carefully. Are you going to be able to support the negative cash flow that you need to justify the rental property? Yeah. So again, you're back to really opportunity cost again.
Right. And if the negative cash flow is $1,000 a month, then the property has to be going up by $1,000 a month, or else I'm kind of underwater. Now, we are ignoring in that analysis taxes.
Yeah.
Because if I'm cash flow negative by $1,000 a month, I guess that's a tax deduction on my rental property, and I can apply it against other.
Possibly. More likely, you're simply not generating taxable income in your rental property. Because remember, part of your cash flow every month is you're paying back some of the capital, the principal on the mortgage.
Yeah, that's true.
And that's not tax deductible at all.
So I guess you need to
you got to be careful with the math.
You got to be careful. Okay, so let's wrap this up. Was this all just a completely wasted show? Am I completely crazy? Like, what is your opinion? Should people be thinking of a house as an investment, or should they be thinking of it as an investment if I can afford it, if my cash flow is positive, or should they not?
So I'm old-fashioned enough to think that for the average Canadian, buying a home is their biggest and best form of investment. They understand it. They have to live someplace anyway. From a cash flow perspective, it costs more than renting, but you are building equity in something, except for those periods of correction. So I still think that a house makes sense for the average person.
And assuming a long enough time horizon?
Assuming a long enough time horizon. So I worry when everybody decides they're going to get into crypto or Bitcoin or all of that stuff, and nobody really understands it. They just think they can make a quick fortune on it. Nobody makes a quick fortune off of houses except for very rare markets. But over time, again, now we're talking time horizon again, you probably don't lose money.
Over time.
Right. So it's more of that forced savings component that you were talking about.
So I guess you got to look at it by saying, will I be at least cash flow neutral each month? Meaning, can I afford it?
Right.
And if I can, okay. And I'm of the view that if the plan is I'm buying this house and my spouse and my kids and my dog and my cat are going to live there for the next 10 or 15 years, then it doesn't really matter. So long as I can cover the costs, so long as I didn't buy too much of a house.
You're not buying it as an investment. You're buying it as a place to live.
Right. And it will turn out to be an investment because 15 years later, I will have paid down the mortgage and the house will be worth more, at least in nominal dollars.
Right.
And therefore, I'm better off. So I totally get that. But the flip side is, okay, so I have to dig into my savings, into my credit cards for $1,000 a month to pay for this house.
Right.
Then clearly it's not an investment, and it's also bad for your cash flow.
Clearly it may not be a good investment.
Yeah.
So that's
I guess you're right.
Right.
An investment can lose money and still be an investment. So I guess my point is, you got to take a step back and don't be rushing into it, because whenever house prices go down a little bit or interest rates go down a little bit, everyone's like, oh, well,
time to buy a house.
Go.
Right.
And then when they go up a little bit, it's, sell. Okay, maybe. But I think if you've got a long enough time horizon, you're probably going to be okay if you can afford it. That's really the big summary. So there you go. I don't know if we accomplished anything or not. Everyone can flame us in the comments about how rambling and disjointed this was. But it's a big topic that I think you always got to step back. And it's even harder for young people because, of course, your parents, who were as old as you.
Right. Hey, Barney, speak up.
It's like, well, we bought our house in 1950 and it's gone up. And okay, well, you paid $37,000 for it.
Right.
And, it was quite easy.
And that won't buy you a car.
No. Well, I'll sell you my car for $37,000. So it is a bit different. You got to look at your own numbers, I think. So, So there you go. If you're watching on YouTube, you can put your comments about how we don't know what we're talking about and we should stick to what we know. Why are you insolvency guys talking about real estate? You don't know anything about this. And the answer is because we are doing more and more insolvencies for people who've had real estate issues. Right. Again, like, subscribe, notification button. We're on Spotify, Apple Podcasts, all the different podcasting streams. So if you don't want to look at us, that is a perfect place to just listen. And we will be back next week with a new episode of Debt Free in 30. Until then, thanks for watching. Thanks for listening. I'm Doug Hoyes. That was Debt Free in 30.